A holding company is a business structure designed to own other companies. Let's break down how this strategy works for businesses and investors. At its core, a holding company exists solely to own enough stock in other companies to control their management and operations. Holding companies are usually shells that don't produce goods or services themselves. They focus entirely on managing assets and controlling their subsidiaries. Businesses use this model to isolate financial risks, manage diverse portfolios under one umbrella, and streamline tax reporting across various subsidiaries. The difference is simple. An operating company creates the actual products you buy, while the holding company sits above them to provide oversight. In a holding structure, if one subsidiary faces a lawsuit or bankruptcy, the parent company and other subsidiaries are usually legally insulated from that damage. Think of the holding company as the architect. It defines the vision and manages the structure, while the subsidiaries are the builders doing the work. Understanding these structures helps you look past the brand name to see the ownership behind it. Subscribe for more finance basics.